Let's talk about the smartest way to pay off your mortgage. Stick with me for the next few minutes, and I promise that what I'm about to show you will likely blow your mind. For over 20 years, I've been advising clients that structure is actually far more important than rate. Shopping for a mortgage is a fool's errand. And if you're here, you're not a fool, right? Bottom line, whether your mortgage rate is 2% or 10%, it really doesn't matter because your bigger problem is that you're paying interest up front. Unless you're a numbers nerd like me, you probably don't think about amortization schedules too much. But here's the super simple explanation. When you take out a 30-year fixed mortgage, the bank calculates what your payment would need to be in order to have the loan paid off if you kept it for the next 30 years. That payment is made up of two parts: principal and interest. On any standard mortgage loan, you're going to pay interest on the balance you owe. And because your loan amount is big, your interest payment is big. For most Americans, in order to afford the monthly payment and eventually pay off the loan, we need to tack on a little extra that gets applied towards the principal balance. So now the next month, your massive loan balance is just a tiny bit lower, and you pay interest again the next month on that slightly lower balance. Now, your interest rate will affect the timing, but even if you locked in a 30-year fixed rate at 3%, it's still going to take you 9 years before more of your monthly payment starts getting applied towards principal rather than interest. At today's rates, in the 7% range, it will take you over 20 years before you end up paying more principal than interest every month. Now, maybe you're saying, okay, Mike, but I'm going to take a 15-year fixed or make additional principal reduction payments every month to knock this down faster. I'm sorry, but even on a 15-year fix, the first third of your mortgage, over half of your monthly payment is going towards interest. Now, if this is starting to depress you, stay with me because I'm about to show you the solution. First, let me show you one other very important thing. The answer is not making additional monthly payments to reduce your principal balance. At 7% on a $500,000 mortgage, an extra $500 a month will still take you 247 months. That's 20 years and 7 months to pay off your mortgage. If you were making no extra payment after the same 247 months, your remaining balance would have been $274,708. But if you had invested that same $500, even at just 8.91%, which is the average return for the past 20 years that takes into account the market crashes in 2008 and 2020, you would have still turned that $500 a month into over $350,000. You'd be ahead by over $76,000. Also, by conservatively investing the money, you would have maintained your liquidity. We tend to overlook the fact that it's dangerous to make additional principal reduction payments because what if you need that cash for something over the next 20 years that you couldn't have possibly foreseen or imagined? Here is the real way for you to win without making additional payments. That's right. What I'm about to show you is how to pay off your mortgage faster and how to do it without changing your current monthly spending. Sound impossible? I'm here to tell you that it's absolutely possible, and I've personally had clients take advantage of this for over the past 17 years. It's not magic, it's math. The secret, there's a product that I now have available again that allows you to pay principal first and interest second. It's a type of mortgage known as an offset mortgage that has been around in countries like Australia, the UK, and Canada for decades. The founder of our company, CMG Financial, brought it to the US in 2005, and I was fortunate to start offering it to my clients back in 2006. Not only did it help dozens of people save their homes when the economy crashed in 2008, but it helped many more save tens, even hundreds of thousands of dollars in interest. In fact, again, without changing anything in their monthly spending habits, we have the data to show that our average borrowers paid off their 30-year mortgages in just 8 to 12 years. Think about that for a moment. What would your personal finances look like if you could eliminate your 30 or even your 15-year fixed mortgage in the next 8 years or less? As I said, what makes this product different from any other mortgage on the market is that it allows you to pay principal first. But instead of talking in theoretical examples, let's look at your mortgage situation. Again, it doesn't matter if your current mortgage rate is 3% or less. Depending on the size of your mortgage, this could save you tens and even hundreds of thousands of dollars. So give me a call right now or shoot me a text and let's schedule a time to take a look at your actual numbers. Sound good? Great. I'm going to be uploading more videos with helpful information, so be sure to hit the like and subscribe. And if you really want to show me some love, please share this video with a friend. I look forward to hearing from you and looking at your exact numbers to see how we can help you. Don't put it off. Call or text me right now, and let's get you off the traditional mortgage treadmill.